Okay, go ahead.
Yes.
Okay, well, thank you everyone for being here this evening. This is actually the third workshop in April because April has been a longer month. And so tonight we're going to be talking about a topic that a lot of people just don't have the time to pay attention to. And so I felt like it was something important to sort of bring up here maybe mid-year and sort of circle back on employee retirement benefits. So in terms of financial planning, in terms of personal finance, we're always talking about saving. We're talking about investing for the long term. We're talking about retirement. But one sort of like very focused area of all of that discussion is our own retirement benefits. So whether we're doing something ourselves with an IRA or a Roth IRA, whether we're saving through the bank, we do have one kind of benefit that really sort of goes unexplained. And because of that, a lot of us that work for companies may not be taking full advantage and maximizing the retirement benefits that are offered through our employer and who we work for. So I wanted to just give sort of a big picture overview of employee retirement benefits, how they work, and just sort of some tips and hints and some basics in terms of maybe feeling a little bit more comfortable with it and maybe going back and either starting yours if you have yet to do that, maybe going back and reviewing what you have perhaps had for years. Sometimes we sort of set it and forget it. And, you know, we glance at a statement here and there. We may log in to our retirement benefits and check it out. But maybe this is just a good reminder to go back and take a look at what's been going on in that account and make sure that you're leveraging it to your advantage. So let's just take a look first at what are the typical employee retirement benefits. Normally, they come in the form of what we call qualified plans. Qualified meaning that they are tax qualified for retirement, okay? And specifically, that means that income that we earn from our employment can go into these accounts before it's taxed. So pre-tax qualified, they grow in these accounts over time, tax deferred, right? So we don't pay any taxes on the growth of the accounts, right? And then when we take the monies out in retirement, that's when we start paying ordinary income tax on the income that we start taking from these retirement accounts. And they come in all different sort of shapes, if you will, okay, or types. Sort of the standard that we all sort of hear about is the 401k. Some people may have a version of the 401k. If you are employed in a nonprofit setting, so you work for a school, you work for a district, you work for a church, perhaps. Any nonprofit entity uses a different version of a 401k. It's called a 403b because, and I'll explain the difference here in just a second, but the 403b does not require a nonprofit organization to make contributions on your behalf. So it allows you to have a retirement benefit or account, but only you make the contributions. Whereas in a 401k, you can make contributions to it and your employer can also make matching contributions to it. And then there's some other versions of qualified retirement plans like a 401a and a 457. Right? But I just sort of throw out that mix of numbers just to let you know that all of these are what we consider to be qualified retirement accounts. They're meant to be long-term investment and savings vehicles for retirement, right? And what we typically see American workers do is they will save in these accounts, and then because life happens, they start dipping into them because of emergencies. They'll take loans against their 401k. They'll pull funds out of their 401k. That's not what these accounts are necessarily meant to do. And there are oftentimes provisions in a 401k, in a 403b, and so on to take out funds for economic hardships, medical situations, hospitalizations. But essentially, these accounts are meant for your retirement after 59 and a half. Some companies use other types of retirement benefits like profit sharing plans. A profit sharing plan, if you work for a for-profit company, they allow you to participate in the profit, in the annual profit of that company. Okay, so if the company is doing well, right, that incentivizes workers to be more productive, to grow the company. If the company is doing well, then you get to participate in a percentage of that company's growth. Other times, companies will give employees the benefit of a stock purchase plan, or they will give you stock options. So let's say, for example, you work for Apple, right? A major corporation. They may give you as an employee a stock purchase plan that allows you to buy company stock, Apple stock, at a discounted price versus somebody who was to just invest in Apple and buy shares in the market on their own. So they're giving you a discount as a benefit to you, right? And you're investing in the company that you actually work for, right? So if you're going to put in the hard work, they're also going to say, look, you're going to help us grow the company because of your productivity, and we're going to give you the benefit of discounted stock. Some companies, and we're seeing less and less of this, some companies still do offer a pension plan. A pension plan is a retirement account that once you've been working for the company for a certain period of time, depends on the provisions of that pension, once you retire from the company, that pension, that retirement account will pay you a monthly income for the rest of your life, right? The downside to the pension is the company is banking on your death. Now, I know that sounds a bit morbid, but the company is expecting you to, at some point, because it's a certainty for all of us, that you will pass. And then if there's any money left in that pension, it could potentially go to the company, right? So these plans, pension plans, are sort of going by the wayside over time because it's expensive for companies to administer and run a pension plan, right? Because it's going to pay you a monthly income for the rest of your life. These are massive long-term costs for a company. So it used to be that in the 60s and the 70s and the 80s and even into the 90s, the main retirement benefit for workers was a pension plan. And if you worked 35 plus years for a company, you would have this massive pension account, and then you could retire and the company would continue to pay you a monthly income until you passed, right? And a lot of American workers banked on that pension plan. But as companies looked for ways to cut costs, pensions were some of the first things to go because they're very expensive to administer. And if the pension doesn't grow and is not invested properly, we're potentially ruining somebody's future retirement, right? So companies didn't want to take on that risk anymore. So pensions are sort of few and far between. Even now, even the cost of administering plans like a 401k for a lot of companies are still very expensive. So when a company looks to cut costs, they start cutting benefits first, right? they try not to lower your salary. They try not to lower your wage. So the first things to kind of go are on the human resources side. They start to lower the benefits because that costs the company, right? So whether it's medical, whether it's dental, whether it's life insurance benefits, whether it's disability, whether it's retirement, these are some of the benefits that for the American worker are like now sort of going away because they're very expensive. It's expensive to manage these things from the company's perspective. So all that to say, if you have a 401k, if you work for a company that is giving you one of these retirement benefits, consider yourself lucky. And if you're not utilizing it, you need to, right? Because compared to the worker that has no benefits, right? You have an advantage. And if you're not using this to grow funds for retirement, you're missing out, right? So if you're unsure of whether you have these employment benefits, go back and ask and double check. Some of us don't even remember when we were first hired, they gave us a packet. They gave us that big folder. Who knows what benefits were inside? I just got to start this job and get going. And we didn't really sort of read through all the material and figure it out, right? Go back to your HR. And if you're unsure of what is being offered, ask them, what are my benefits? Educate me on what I can use in terms of all those benefits, from medical to retirement to insurance, life insurance. Take full advantage, because if you're not, then you're leaving money on the table. So it's like telling your employer, I don't want these extra benefits. I don't want to save long-term for retirement and have you make matching contributions. So it's like telling your company, I don't want more money. And a lot of times workers don't utilize these benefits because they just don't understand how they work, right? So that's why it's really important for us to talk about this today, because sort of every year that you don't utilize the benefits, you're falling behind. You're sort of not leveraging the power of what you could potentially have. Take a look at this. If you had started leveraging retirement benefits when you were in your 20s, okay? If you look at this graph, the earlier you start in that dark blue, this first curve, if you had started in your 20s and you had made annual contributions to your 401k of, let's just say $6,000 a year, right? And that earned on average 7% a year, year to year, being invested in the market. By the time you are 60, you would have over $700,000 in your retirement account. So that's the ideal, right? Start early. But I also show you this graph because if you haven't started, or if you've had stops and starts, right? You started making some contributions, you got overly aggressive, and you're like, oh my gosh, I can't contribute. I need every dollar in my pocket, right? And you stopped, right? Now is the time to start back up again. If you haven't started any benefits at all, now is the time to start. So look, even if we started saving in our 40s, right? You could see that earning 7% a year by the time that we're 60, we could have upwards of $400,000, right? So I understand life happens, shoulda, woulda, coulda, right? So if you haven't been doing that, there's no better time than right now to start using your employee retirement benefits, okay? So how do we take advantage of this benefit from our employer, okay? So first, you need to figure out, right, what plan do I actually have? Is it a 401k? Is it a 403b? What is it a stock option plan? What is actually being offered to me? And then you need to figure out, does my employer contribute to the plan? If your employer contributes, they probably contribute based on a percentage, right? On average, and every employer is different. This is not the same across every company. Every employer has a different policy. Some employers don't make a match. They don't contribute anything. It's solely up to you and from your paycheck. Other employers, on average, will contribute somewhere between 3 to 4%. Okay? Meaning that they will match whatever you contribute up to 3 to 4% of your salary. Okay? Some companies will match up to a certain percentage, dollar for dollar, what you contribute. So all that to say, every company sort of has a different policy about what monies they put in on your behalf. So that's the next thing that you need to find out. What plan do I have? What benefit do I have? And then from there, what is the company match? Okay. Are they putting in anything? And if so, how much? If you have a 401k and you're not making any contributions, then more than likely the company is not making any contributions, right? So that's where we're sort of leaving money on the table and we're saying no to our company. No, we don't want your match. So we're telling them we don't want more money. Okay. Some plans, the next thing you want to figure out, have automatic enrollment. So some of you might be sitting here thinking, well, I think I maybe do have a 401k, or wait a second, maybe I don't, like, I'm not sure. I think I enrolled. Some companies have automatic enrollment to incentivize their workers to just automatically join. So you may actually have a 401k, right? And maybe you're just not even getting statements for it because you have to be logging in and you never bothered to set up the login, right? So you want to know, what are the features of this particular plan? How do I access it? How do I see it? Do you have an HR portal at work that you log into, right? Start asking these questions. There's no harm in figuring out what's what, because the more you become armed with that information, the better you can manage these accounts, right? The next question to then ask is, okay, if I have a 401k and if my company is matching, right? And how do I access it? How do I see it? The next question is, when is it mine? So the fancy terminology that we use for this is, when does my account, when am I vested? When does my account become 100% mine, right? The reason you need to ask this is because a lot of companies have a stipulation that in order to be 100% vested, meaning 100% of the account value is yours, is you have to work for a certain period of time. Some companies, it's 2 years. Other companies, 3 to 4. Some companies may say 8 years. It all depends. That's what you want to find out. How long do I have to work here for that account value to be 100% mine? Your contributions are always yours, but we want to know when we're 100% vested, because we want to know, when is it my contributions and the company's contributions 100% mine? Okay, so that's the next thing to find out about your plan. I get this question a lot. Brian, what if I've worked for multiple companies over my work life, and I had a 401k at this company, and then I moved on and got a new job, and then I got a new 401k at that company, and now I sort of feel like in my work history I have like 3 different 401ks. These retirement benefits that companies offer in the form of a 401k and a 403b and so on are what we call portable, meaning you can take them with you as you move on to different jobs. So if you have a 401k, you have several different options if you change jobs. One, you can leave it at that former employer. You could leave it in the plan. Okay. What are the reasons to leave it in the plan? Maybe it has good investments. Maybe it's been doing well, right? And you just want to leave it. Okay. So a lot of plans allow you to just leave it in the plan. Other plans, depending on the balance, may automatically sort of kick you out of the plan once you no longer work for the company. I've seen some plans kick people out if they have below a certain value in the account. So for example, let's say you had less than $5,000, you may end up getting a check in the mailbox, right? Sorry, you left this company, you only had $3,000 in the account, here it is. They want to just get you off the books because it costs them to manage and administer your plan. So they get all the little accounts off the books. The problem with that is that if you don't take that money and put it into another qualified retirement account, like an IRA, that's taxable income. So if you're like, oh, wow, they just sent me my 401k money, I'm going to go deposit that or cash that. That's taxable income because they're going to report that to the IRS. So you have to show, no, I took that and I put it right back into a qualified retirement account. Okay. So you could keep it in the plan unless they kick you out. The second thing that you do is because it's portable, you can move it with you. So let's say your new employer has a 401k plan. A lot of 401k plans, you can roll your old one into your new employer plan and just add those monies right to your new jobs plan. Okay. So it's portable. You're basically taking it with you, dumping it into your new jobs plan. Okay. The last thing that you could do with it, as I just mentioned, is it's portable in that you could roll it into another qualified retirement account like an IRA. Okay. A traditional IRA, individualized retirement account, right? So rolling it into an IRA is non-taxable, right? You're not going to get taxed, and it continues to grow long-term for retirement. The advantage of the IRA is that you can choose whatever investments you want, not just the investments that are in the plan. So a lot of times it's better if you have an old 401k to look at the investments in the plan and say, am I sort of limited, or should I just take it with me into my new 401k plan? Or would it be even better to roll it into an IRA and I just choose what stocks, bonds, mutual funds, or whatever investments I want to use? Okay. So that's what I mean by the 401k or the retirement benefit being portable. You basically take it with you. Okay. So a lot of these are great advantages for us, right? We can get matching money from the company potentially. Okay. We got to make sure that we're vested, that we work long enough so that our contributions and the company's contributions are 100% ours. And if we change jobs, we can take it with us. Okay. So we're sort of in control of this benefit now. One other benefit that we may have the option to utilize, some companies will use this, is they will offer you a 401k and a secondary option that's called a Roth 401k. So a Roth 401k acts a little bit differently. And if you have this option at work, you could actually have monies in your 401k and in the Roth 401k. So basically 2 buckets, okay? The Roth 401k uses after-tax money. So you pay the taxes on it right now. It goes into the Roth option, right? It grows tax deferred as it's invested. And then in retirement, when you take money from it for income, you have tax-free withdrawal on the growth, on the earnings. So just to compare that advantage to just the 401k, remember we said with the 401k, you put in money pre-tax, you're not taxed on it, it grows tax deferred, and then when we take it out, the IRS gets us and it's taxable. The Roth version, we pay the taxes on it now, it goes in after tax, it grows tax deferred, and then when we take it out in retirement, it's tax free. So if you put money in both of those buckets, in retirement, you'd have some taxable income, and with the Roth option, you'd have some tax-free income, right? So it's just another advantageous way to help us save for retirement, and in retirement, get some non-taxable money versus all of our money being taxable. Okay. So look for the Roth option. Now, if your company plan does not have a Roth 401k option, you can open up a Roth IRA outside of work, right? So just like you can get an IRA, you can also open a Roth IRA. And you could start saving after-tax money for tax-free income in retirement outside of the company. You don't need the Roth 401k necessarily. You can use a Roth IRA. So the thing with opening an IRA or a Roth IRA outside of your company benefits is there are limitations to how much you can contribute. And right now, in the 2020 tax year and the 21 tax year, if you are up to the age of 50 and a half, you can contribute $6,000 a year to an IRA. If you're 50 and a half and older, they allow you to contribute up to $7,000 a year. So because of those limits, you can't dump a ton of money and really ramp up an IRA or a Roth IRA. But like we saw from the chart, if you do it consistently and annually over time, it will definitely grow. The advantage to the 401k and the Roth 401k is that there are higher limits to what you can contribute. For example, in the 401k, you can contribute up to $24,500 a year, right? So it's a way for you to maximize, right, your retirement savings through your company plan first. So whenever people ask me, Brian, how can I just really ramp up saving for retirement? I always ask them, do you have a 401k? Because that's where you can put in a lot more money. So first, max out your 401k contributions, right? Then consider doing an IRA, okay? Because you can get the most sort of tucked into the 401k, more so than the IRA. When you're thinking about your retirement benefits, you have to think long-term, okay? These are not savings buckets where you make contributions from your paycheck and then, 2 months from now, you take some money out to take a vacation. And then, gosh, I think I need a new car. You just pull some money out from the 401k. That's not what they're meant for. Unfortunately, people do this all the time, and they take loans against their 401k. But what it's doing is it's affecting your retirement income long-term. So you're making short-term sacrifices for essentially affecting you long-term, right? Yeah, it's okay. I'll just take the money out now. I'll put it back in. And most of the time, most people don't put it back in, right? So think of it long-term. In terms of how it's invested, your 401k, 403b will have investment options or choices in how your money is invested in the account. This is where a lot of workers will say, I have no idea how investing works, and I can't sit and read this and figure this out. So I don't even want to bother with this, and they won't open one, right? So you can keep it simple. A lot of 401ks, in terms of the funds, will have what are called age-based funds. So all you have to do is it really simplifies things, and it says, look, if you're within this age band, let's say you're 35 to 45, use this fund. If you're 50 to 65, use this fund. Okay. Those funds are geared towards the age bracket that you fall in, and the risk is set to be aggressive or conservative based on how close to retirement you are, right? So if you don't want to have to figure out, like, I don't know, am I being too aggressive? Am I not being aggressive enough? Like, I don't even know how this works. A lot of 401k plans have simplified the fund choices by giving you, for example, an age-based option. Some of them will have what are called target date funds, meaning all you have to do is say, I'd like to retire at 65. So based on retiring at 65, I will use this target date, meaning I will retire in 2035. That's when I'll be 65. You would use the 2035 target date fund. And right now, as you're farther away from retirement, it's going to be more aggressive to try to get you growth. And then as it moves closer to that target date of 2035, it will get more and more and more conservative to start preserving your money as you get closer to retirement, right? So some plans do have very simplified ways of just making easy investment choices. Okay. Oftentimes in people's 401k plans, I'll see somebody who has put all their eggs in one basket, meaning they put all their contributions and they put all of the company's matching contributions into one fund or into the company stock, right? I don't know, somebody works for AT&T and they're just like, I'm just going to bank on this company that I work for. And all they buy is AT&T stock. And all the matching goes right to AT&T stock, right? That is a huge risk. I know you love your company and I know you're working hard for it, but no company is fail-proof, right? So don't put all your eggs in that company's basket. So even if you work for Apple, even if you work for Tesla, even if you work for Google, and these stock prices continue to climb, diversify your money. Yes, buy some company stock, invest in the company that you work for. You're helping it grow, but at the same time, put some in the target date fund, put some in the age-based fund, right? Diversify. Other tip that I want to mention is avoid timing the market. What I mean by this is your 401k account is not meant for you to be actively buying and selling funds and stocks. It's not a trading account. So I've seen a lot of workers who are like, oh, my 401k, I want to try to like dabble in the stock market. And they will try to actively buy and sell within their 401k. That's not what that's meant for. Do that in an outside brokerage account, in a trading account. Vanguard, Charles Schwab, TD Ameritrade. Do that on a different platform, okay? Because I see a lot of workers who will say, oh my gosh, the market is taking a hit. So they'll go into their 401k, they'll sell all the funds and they'll go to cash, right? To try to avoid losses, try to avoid a market meltdown, try to avoid a financial emergency that our economy is having. Makes sense. Of course, we want to preserve our money. But then when the market starts recovering, right, this is where workers get it wrong because you can't time the market. You don't know exactly that point when it's going to start to go back up. And what if you're not paying attention? And what if you miss that? Well, now you're sitting all in cash. And if the market starts rebounding, you're missing that growth. And by the time you figure out, oh, shoot, I got to reinvest, the market has already gone up. You've missed the growth. And now you're buying at higher prices, right? So maybe you sold low. This is the opposite of what you want to do. You sold low and now you're having to buy high, right? Because you were trying to time the market. Just let it be, right? Let it be. The market will recover, right? You'll get that back. Probably the most difficult thing though is when it comes to the 401k, when you retire and the income that you're going to start pulling from that 401k is sort of dependent upon what the market is doing. So for example, in 2008, we had a huge stock market drop, right? In that recession of 2008 to 11, stock market took a huge hit. 401ks dropped by over 30%. If you were trying to retire that year, your 401k account was down 30+% potentially. Probably not a good time to be retiring, right? So obviously you don't want to put all of your retirement plans on your 401k account, right? In terms of how you're planning your life. But that could potentially have ramifications. And if you're toying around with going to cash and reinvesting and sort of trying to manage the ups and downs of the market, that can be very difficult when you're ready to pull the trigger for retirement. Okay. I'll just say one quick thing about, let's say you were to retire tomorrow. You're 65, you're done, you put in your time, you're ready to retire. Again, the 401k is portable when you retire, meaning you could start taking income from the 401k account and leave it there. Or what most people do is they roll it into an IRA, right? And then they manage it. They're done with the company. They manage it. They start taking income now from the IRA, right? So even in retirement, it's portable. You take it with you, okay? Last thing I want to say here about employee retirement plans. If you have one, whether it's a 401k, 401k, 403b, any of those accounts, please, please, please check your beneficiaries on those accounts. Maybe you started working with this company 17 years ago, right? You probably opened the 401k. I don't know what was happening in your life at that time, right? Maybe you had a different spouse then. Maybe your life situation was different. And when you started that job, you named certain people as beneficiaries, right? And over the 17 years, your situation has changed and you have not updated the beneficiaries over 17 years. People are getting separated, divorced all the time. People pass away. Stuff happens in family dynamics, and make sure that you update your beneficiaries, okay? Because if something were to happen to you tomorrow, God forbid, you would want to make sure that your 401k retirement account went to the beneficiaries or the people who you want it to go to, okay? So that's something that often gets overlooked just because we're so busy with life. We sort of set it, we forget it, right? And then life is changing and life is happening and we forget to go back and update those things, right? So take a look. If anything, this is a reminder to take a look at your beneficiaries, take a look at how your account is invested. Did you go to cash a while ago and then you forgot to reinvest it and it's just been sitting there in cash, not growing? That's something to take a look at, right? Maybe the investment options in your plan have changed, right? That often happens. It's good to go back in and say, oh, what's available to me? When I first started this account, there was only 8 funds I could choose from, and now they expanded it to 15. What's available? What can I do, right? It's good to take a look at it. So I know it takes a little bit of effort. You got to figure out your login. You got to look at some statements. You got to check things out. If you don't want to figure it out, go to HR, right? Ask them, how do I access this? What are my options now? They have materials on all that. They can walk you through that, right? If you work for a company that is not big enough to have an HR department, what I would suggest that you do is talk to somebody like myself, talk to a financial planner who can walk you through your scenario. Do you have old 401ks? Or in your current 401k, let's take a look at your investment options and let's build a portfolio of funds from your choices that is good for the market right now based on our current economic situation and how close you are to retirement, right? So just by gathering more information, asking for help, right, you can definitely leverage this benefit. And like I said at the very beginning, the fact that you have it is huge because these benefits are becoming few and far between. So many companies just aren't even offering this anymore, right? Because it's additional cost for them. So if you know you have it and you haven't started it, or if you know that you have it and you just haven't looked at it in a long time, get in touch with Lisa, get in touch with myself, and we'll help you get help with it, and we'll help you take a look at it. In 2 weeks from now, we're going to circle back on credit. And the reason I'm circling back on credit is because I've been getting a lot of different questions just in general. I think it's because we're sort of coming out of COVID and we've been having to manage our finances differently in terms of credit and what the Biden administration is trying to do in terms of student loan debt and interest rates right now. And I want to circle back and address debt and credit and how best sort of mid-year here to like come back and take a look at what we're doing with credit and debt. So that's going to be on May 13th at 6 p.m. Lisa, in between these workshops, did you just want to plug anything else that you have going on?
Yeah, so May 6th and May 20th, Gain Federal Credit Union is going to be presenting a workshop. The first workshop is going to be about home buying, and I really encourage you guys to try to attend both of those, just because they're offering $100 off your rent, and it's going to be for the select few that do attend. So just make sure you log in.
I did.
Yeah. So it's going to be the 6th, and that one's going to be home buying. And then the second one on the 20th is going to be about budget and debt management. So similar
Awesome.
topics, but yeah.
I always
Awesome.
like it because I like to be in reinforced. That's why I keep
Yeah.
coming to the classes.
Perfect. Perfect.
Yep. So that's that.
Well, thank you guys so much for attending, and definitely if you're not seeing an invite, or if you want to make sure that you RSVP for those workshops that Lisa just mentioned, make sure that you reach out to her. She'll get you that information. And I'll see you guys on the 13th.
Yep.
Okay, Brian.
Right.
Thank you so much. Thank you,
Thank
guys.
you.
Have a
All
great
right, bye.
evening.
Have a good night.